All right. Good morning. Today is July 9, and what we're going to do today is that we will practice on chapter 14, long-term liabilities, especially the bonds, and then we're going to move on to chapter 15. And chapter 15 is the statement of cash flows. All right. First, let me give you a copy of chapter 14 assignment. Chapter 14. I haven't posted chapter 14 online yet, but hopefully by the end of today or tomorrow, chapter 14 assignment will also be online. Oh, let me also give you some material for chapter 15. Instead of flipping between pages back and forth, so I'll give you the pages. There's a page. It's from the chapter, from the book.
Oh, chapter 14?
15.
15.
Yeah, when we come to that, so I thought I'll make some copies so you don't have to flip from page to page while we're doing that. Okay, so let's go to the textbook, to problem 4, page 594. I thought this problem is kind of a comprehensive problem as it relates to bonds payable, and that's the main point that I'm focusing on this chapter. Bonds and bonds accounting and bonds, other related material. Okay, problem 4. Got it? Page 594. Yes, sir. Okay. Yakuma Corporation issued bonds. Oh, let me go to Word first. Good morning, Brother Grimm.
Good morning.
Okay, here is a
Thank you.
chapter 14, and I think I may have 13 also for you. This is chapter 13.
Remember how they said we was getting financial aid for the second?
Brother Grimm is okay. I mean, you are current.
Yes, sir.
You have been for from, I think, day 1 or 2.
Thank you.
This is for chapter 15. We're going to be needing that later. Okay, we are on problem 4, page 594. You may want to sit next to Brother Bailey so you can join him and look at the book. Yakuma Corporation issued bonds twice during 2014. The transactions follow. Okay, in 2014, on January 1st, Yakuma Corporation issued 2 million of 9.2% 10-year bonds dated January 1st, 2014 with interest payable on June 30 and December 31st. The bonds were sold at 98.1, resulting in an effective interest rate of 9.5%. Now, what does 98.1 mean?
It was sold at a discount, right?
Yes, sir. At 98.1% of the face value. So, on January 1st, so for 2014, okay, let me go to problem 4, page 594. So the ones online can observe what we are doing. All right. So in 2014, for the year 2014, January 1st, all right, under January 1st, what do we debit? Since we are issuing it at 98.1%, Brother Bailey, what do we debit? Remember when we issue bonds,
We debit
what are we getting?
we're getting
Cash.
Cash.
Yeah, we're getting cash. So we're going to debit cash for how much?
2 million.
Nope.
Oh, Oh wait, for 98.1%.
Yes, sir. Uh-huh.
Alright, so I gotta do something.
Which is
Let me hold up. Let me find
cash 98.1% times 2 million.
Oh, it's 2.
Mm-hmm. $1 million?
1,009,600.
Yes. 1,000,000 962,000. And immediately, what do we credit? Before we do both the bonds discount or premium, we credit bonds payable automatically. All right, we credit. We go one more down. Credit bonds payable at 2 million. Now, the difference, what do we call it?
the unamortized.
Unamortized bond discount. Unamortized bond discount for how much? Let me put that a little bit further. Both of these. How much you said? Yes. 38. Oops, let me also make it a little bit further.
Yeah, 38,000.
So 38,000. All right, that's correct. That's on January 1st. Remember, the interest is payable twice. Okay, it's payable on January 1st, and now there is no interest because it's just issued today. All right, okay. On April 1st. Okay, let's go to April 1st. April 1st. What happened on April 1st?
Issue 4 million of 9.8% 10-year bonds dated April 1st, 2014, with interest payable on March 31st and September 30th. The bonds were sold at 101%, resulting in an effective interest rate of 9.5%.
All right, so this one is going to be at premium.
Mm-hmm.
So immediately we debit what?
Cash.
We debit cash for how much?
101% of 4 million.
Uh-huh. Which is?
I'm trying to do it.
Huh?
So that's 4 million for.
Don't look at that. Look at your stuff.
No, I'm on the
Oh,
calculator.
okay.
I'm doing-
Yeah. No, you didn't do it. Yeah. Look at your stuff. Don't look at mine. Show it on your calculator.
That's what I was doing. I was finding 1%.
Go ahead and do it.
Yeah, I was finding 1% of 4 million, then adding 4 million onto that would be 4,040,000.
But do it.
400.
See. 4 million, correct?
Yes, sir.
1, 2, 3 times
9.8.
101 divided by 100. See?
That's not even what you got.
Oh, 1.5, not 1%. 1 and it was issued at 101. Okay, 101. Here, 101 divided by 100 equal this much times 4 million. 1, 4, 1, 2, 3, 1, 2, 3.
See,
Oh.
you divided again. I got you though. I know.
You got it. Well, first do the easy way. 1, yes, that's it. 101 over 100.
Add any time for me.
Okay, yes, sir.
101.
And we immediately credit. Come on, you should know that.
The
What?
amortized bond premium.
No,
Yeah.
we immediately credit bonds payable. How
Bonds
many times we
owed.
have to say that?
Oh,
Bond
well, that could be my
credit,
fault. I was doing too bad.
bonds payable for
4 million.
4 million. And the difference is,
40,000.
what do we call it?
Unamortized bond
Yes, sir.
premium.
Unamortized bond premium for $40,000. Okay? All right, so that's on January 1st and April 1st. Now, June 30th. What happened on June 30th?
Pay semi-annual interest on the January 1st issue and amortize the discount using the effective interest method.
All right, we're using the effective interest method. So, what is the amount of interest expense using the effective interest method?
It's just for the January 1st one. That's 9.5%.
Okay, times
The semi-annual interest.
we use to figure out the interest expense. We use the effective interest method, which is the effective interest rate, which is the market interest rate. So we use what is the carrying value of the bond, or the amount of cash that we got, which is 196 to 1,962,000. Okay, so we're going to say this is on June 30th. June 30. That's after 6 months was issued on January 1st, correct? So on June 30, we're going to say 1,962,000 times the market interest rate, which is on the first bond. What was the market interest rate?
9.2.
No, that was the
Effective interest rate.
stated 9.5
9.5.
times 9.5 over 100 times the time, which is 6 months over 12. 6 over 12. So that would give us what? So, okay, let me go and get my calculator too, so I can do. I don't like the cell phone.
I got 93,195.
What did you get?
93,195.
How much?
93,195.
93,195. Okay. So, let me, 1,962,123 times 9.5 times 6 divided by 12. So that give me, how much you got?
93,195.
Yes. 93,195. So, yeah. 93,000. 195. Okay, so we're gonna debit interest expense. We're gonna debit interest expense for 195. All right, and we're gonna credit automatically. We credit the cash. Okay, credit the cash, which is, how much was the cash? The cash is supposed to be 2 million times 9.2% times 6/12. Supposed to be 2 millions. Thank you.
Times 9.2%.
Yeah. Thank you. Times 9.2 divided by 100 equal this much times 6/12. Excuse me. And that gives us 1,086. Did you get the same amount?
92,000.
Yeah, so I got 92,000.
Huh?
92,000.
92?
Mm-hmm.
You're better than mine, yeah.
What did you get?
Okay, okay. 90, let me see. 9.6%, sorry, 9.2%, 9.2 divided by 100 equal this much times
6
times 6,
divided by 12.
okay, divided by 12, that gives me 0.046
How you get 0.046?
times 2 million.
Oh, you have a times 2.
1, 2, 3, 1, 2, 3. Yeah, 92,000. Yes, sir. So the amount of cash is going to be credited for 92,000. 92,000, and the difference between the two is
1,100.
unamortized bond discount. The difference between the two is unamortized bond discount, which is how much?
1,195.
1,195. Yes, sir. Credit. See, I'm making too much space. There should be not too much space between the two. Credit. One more time again.
Unamortized bond discount.
Discount. For how much?
1,195.
All right, we good. All right, since we are, let me reduce the distance between these two. Make it look. Oops, yeah, make it looks more professional. Yeah. All right. Now we're gonna update the new carrying value. Okay. Are they asking us to do that, or it says
No.
paid premium? Okay. Paid semi-annual. Okay. So it's only one-time payment. It looks like, not 2 times. Now we go to the second one on September 30th. Okay, September 30th. September 30th. What do we have on September 30th?
Pay semi-annual interest on the April 1st issue and amortize the premium using effective interest method.
All right. So, what is the carrying value of the bond?
This is for the one that was issued on April 1st. So the carrying value is
What is the carrying value of the bond for the April issue?
4 million? Oh, 4,040,000.
$4,040,000 times the market interest rate
9.5.
times 6/12. So we're going to say 4,040,000 1, 2, 3 times the market interest rate
9.5 over 100.
9.5, yes sir, 5 times 6/12, and that's equal to what?
191,900.
191, that's correct, 191,900. Okay, so we're going to debit interest expense by,
191.
yes sir. All right, so we're going to debit interest expense for, how much you said?
191,900.
191,100.
900.
Huh?
900.
Ah, okay. 191,900. And we're going to credit what? Immediately?
Cash.
Cash. Yeah, he's right. Cash.
Oh, yeah.
Credit cash for,
Yeah, fine.
going to credit cash for
We gotta do,
face value times the stated interest rate times 6/12. So the face value is what?
4 million.
Face value is 4 million, times the stated interest rate,
9.8%.
yes sir, times 9.8 times
6/12.
6/12, and that gives us
196,000.
all right, 196,000. So the difference is by how much?
4,200.
And we call that what?
It's 41.
The unamortized.
Unamortized bond premium.
Premium.
Yeah. Undebit. Unamortized bond premium for,
4,100.
yes sir, 4,100. All right, so this is requirement. Which requirement is that? That's number we did now December 31st. What happened on December 31st?
Pay semi-annual interest on January 1st issue and amortize the discount using the effective interest method.
That means another interest payment on which one? Which one of the two?
The January 1st. So this is the last, well, not the last payment.
December 31st, correct?
Yeah.
December 31st, paid semi-annual January 1st issue and amortize the discount. So that was the first one.
Mm-hmm.
Okay, on the first one, we need to update the new carrying value. All right, so what is the new carrying value? Okay, so December 31st. Okay, the new carrying value of the of January 1st issue. The new carrying value of the January 1st issue is equal to the, what was the, it was, first of all, it was
The first
it was 196 2000. 196 2000. That's what was it?
1,962,000.
Yeah, 1,962,000 plus we're going to add what? What we have amortized, which is, how much did we amortize?
1,195.
Yes, sir. 1,195, we said?
1,195.
And that's equal to
1,963,195.
1,963,195. All right, that's the new carrying value. Now we're going to multiply that by the same thing we did at first. So 1,963,195,000 times the
9.5 divided by 100.
It was 9.5?
Yeah.
Yes, sir. 9.5 divided by 100 times
divided by 12.
times 6 divided by 12. And that gives us, what does it give us? Say one more time.
93,251.7625. So
93 251 0.76. 0.76. Okay, so now we go like what we did earlier. We're going to debit interest as our interest expense. So we're going to debit interest expense by how much? By that much, which is 93,251. 93,251. Let's make it 252.
okay.
93,252,000. Okay, and then we're going to credit what?
Cash.
Exactly. Oops. Let me move this to the next page. Cash is the same amount like what we did earlier, if you remember. What was the amount of cash earlier?
92,000.
Yes, sir. 92,000. And the difference is
1,252.
1,252. What do we call that?
An amortized bond discount.
Yes, sir. Credit unamortized bond discount. Okay, so If you want to do one more, then you update the new carrying value, multiply by 6 over 12 times the effective interest rate. Okay, and you can keep doing that until you get to
Year 10 years.
until you get to the face value of the bond. You keep updating it until you get to the face value of the bond. Okay, so that's December 31st. December 31st, the second one is also related to same thing. We update the new carrying value. So we update the new carrying value is 40,000, correct? 4 million. So December 31st, second one, the new carrying value is 4,040,123 times the effective interest rate, which is 9.5 divided by 100 times 6 divided by 12, and that gives us what? What does it give us?
I'm doing it right now. 191,900.
How much?
191,900. You know what we're supposed to do first? We gotta add the premium on, I guess.
Oh, you're right.
Yeah.
Ooh, you're right about that.
That's why we get the same.
Yes, sir. So let's go back to you're right. 4,040,000 plus
4,100.
plus 4,100, and that gives us 4,044,100, correct? 4,044,100. Now we multiply 4,044,100
times 9.5.
Uh-huh.
100 times 6 over 12.
And we get, yeah, well, you 29 40 million for 41,400, correct?
Yes, sir.
1,400. Hey, Doc. Did you need anything, Doc? Excuse me for a second.
Man, what y'all homework do?
Shit, since we could have glad this one ever.
Look, I forgot. I ain't realize we had how much I pulled up.
I forgot. I've been at work doing the books for people.
It was I worked, then I got a few days. I'm like, as soon as I pull up on camera, I'm like, oh shit, we got homework.
There's only one assignment, just chapter 13 assignment.
Yeah.
Every day he gave us.
Yeah.
And 14, right? Well, he just gave us this today. He hasn't even put it on Jigsaw.
What we get today?
Huh?
Oh, I ain't got
Okay.
Oh, he didn't look.
So, what do we get? 400 or for
192,094.
192,000?
And 94.
192,094?
Yes, sir.
094?
Yes, sir.
Okay, so,
0.75.
huh?
0.75, or do you just want to keep it at,
I'll get it to 95?
yeah,
Okay.
192,095.
Okay. So, we're going to debit interest expense. This interest expense. Let's hold on that for a second. Debit. Oops. And we immediately going to credit what?
Cash.
Cash for how much?
196,000.
Let me. Cash for how much you said? 196. Oops, 196. 1, 2, 3. All right, and we're going to debit what?
Bond premium.
Huh?
Unamortized bond premium.
Unamortized bond premium. Now
For 3,905. Remember, with this premium, that's going to continue to go down.
okay, made an end of year adjusting entry to accrue April 1st issue and go back to where did we get the cash was supposed to be 92,000,
That's for the other one, Dr.
huh?
That's for the other one.
The cash was 196. Ah, okay, yeah. So in this case, the interest expense, okay, is going to be the difference between 192.
No, we already got the interest expense. That's the interest expense is the 192,095.
Yes, that's I'm talking about the premium.
The premium is the difference between 196,000
Yes,
and
uh-huh.
192,000.
Yes. So the expense is 192,
95.
huh?
Is it plus or divided?
192,095,
95.
correct?
Yes, sir.
And the unamortized premium is going to be the difference between the two,
Yes, sir.
which is
3,905.
3,905.
Yes, sir.
905. Okay. Okay. Let's look one more time. On the 2nd December 31st. The bond was issued when? April 1st. On April 1st. It was issued on what? April 1st, correct?
Yes, sir.
All right. Made an end of year adjusting entry to accrue interest on April 1st issue to amortize half the premium. See, to amortize half the premium. See, that's the issue that we are. I'll tell you what. Let's just leave it like this, all right? For the whole 6 months, yeah. We're not going to go into too much detail. We'll just leave it like that. If we were to do half of the premium, that means it's going to be half of 3,905. Yeah. If we were to do that, yeah. All right. Mhm.
1,900.
Yes. Yes. If we were to do that, so we'll just leave it alone. Leave it as that a whole 6 months. Okay, a whole half year. Okay, so in the 2015, what happened on 2015? Paid semi-annual interest on April 1st issue and amortized the premium applicable to the second half of the second year.
So we just did two of the problems together. basically.
Huh?
We just did two of the problems together then, because that's just asking for the other half.
Yes, Uh-huh.
So we,
Yeah, you're right for the other half, yeah.
so we just did it all.
But I think that's enough for now. Let's see. Let's go back to the. So we did number one. We did number one. Number two, it says describe the effect of the above transaction on. Okay, profitability and liquidity by answering the following question. What is the total interest expense for 2014? What is the total interest expense for 2014?
For which one?
For both, I guess. That's what you're asking, yeah.
So I guess we gotta add up all the interest expense that we had.
Add both from the for everything wherever you see interest expense, add it. Wherever you see interest expense, add it. So we had one on June 30th.
93,195.
93. Okay, so let me go back.
And we have one on September 30th.
1 second. Number 2. A. Total interest expense we have how much? 93,195 plus
191,900 on September 30th.
191,100.
900.
Oh, 900. Sorry. 191,900 plus
93,252 on December 31st.
93,252 plus one more.
192,95. 92.
Because we counted the whole 6 months, yeah.
192.
192,095. And that will give us
570,442.
okay, all right. B, what is the total cash paid in 2014 for each of the bonds issued? So you go back to the cash, wherever we have a cash. Okay, number 3, wherever we have a cash. All right, what do we have?
So cash, let's see. We got the debit, right?
Say it again.
We're gonna add up all the debited cash or the ones how.
No, okay,
Like I'm saying, you know, so we got cash as credit.
it says cash paid, not received.
Oh, cash paid. Okay.
Cash paid.
All the credited cash.
Yes.
So let's see. The first one is 92,000.
92,000 plus
Let's see, 196,000
196,000 plus
92,000.
92,000. Yes. And that's all.
And we still got one more for 196,000.
No, that's it.
Oh, okay, yeah.
Yeah.
Yes,
We got the 196. Yeah.
I mean, this is not on December 31st.
No, that on December yeah, that's it. And you're talking about 2015. We didn't do
Oh,
2015.
Okay.
Yeah, we didn't do
So
2015.
that's
Yeah.
380,000.
Yes, sir. 380,000. All right. I think that's enough practice for the bonds. I think we did we talked about the bonds upside down.
Sideways,
And,
backwards, forwards.
one thing we didn't practice is retirement of bonds. Retirement bonds meaning paying off your liability.
Oh,
That means you have to debit bonds payable, you have to credit whatever you have paid, and you also have to take care of whether you have discount or premium that hasn't been amortized yet. Okay, that's when you retire the bonds. You get rid of the liability, and you get rid of everything belong to that bond that hasn't been taken care of. Yeah, whether it's premium, the balance of the premium discount, or sorry, the balance of the unamortized premium or unamortized discount. Okay? Of course, you're going to credit cash. See, what happens if you paid cash to more than the liability and the unamortized premium or discount?
So if you pay more cash,
More than, yeah. I mean, because sometimes you pay more in order you want to pay off your liability early,
oh,
and you give the people some incentives, yeah.
oh,
Yeah, so you may
didn't
end
have
up
to?
with a loss.
Oh,
Yeah, you may end up with a little bit of loss. Or if you pay less than, that means like a settlement, that's it. If you pay less than what you owe, I mean, you have a gain in this case.
because you don't have to pay a full amount.
Yes. All right. With that in mind, let's move to chapter 15 and introduce it. Reverend Dane, here's a chapter 14 assignment.
Thank you, sir.
And I think I gave you 13 last time.
You get to the
And also for this chapter, let me give you this sheet for chapter 15.
all right.
So you don't have to flip.
All right.
Okay. Brother Grim, did I give you those two? Or
Yes, sir.
All right. And you have chapter 13 and 14 assignments.
Yes, sir.
Okay. Let's go to chapter 15. Now I already has it. It is the statement of cash flows. Okay. What kind of idea you get when you see this title? What kind of impression you get?
Statement of care. I want to.
Statement of cash flow is like everything where your money's going, when it's coming in, going, everywhere.
And from what sources they are?
I said,
Cash inflows and cash outflows to the business. Yes. And it could be coming from different sources. Yeah. Now, if you are receiving cash, that does not necessarily mean that's coming from revenue, because you could be receiving cash through borrowing money or through
Somebody
issuing
paying back.
bonds. Yeah.
Somebody paying back what they owe.
And you could be spending cash not necessarily to do business, maybe to pay off your
Debt,
needs. Yeah.
liability.
Yes, sir. Pay off your debts or to buy some of your needs.
Probably to go
So-
on vacation.
A statement of cash flows shows how a company's operating, investing, and financing activities have affected cash during the period. So when we said cash inflows, outflows from different sources, and by sources we talk about the operating activities, your investing activities, and financing activities. And we're going to define each of these in a minute. Yeah. Okay. How do you define cash? What is cash? It includes cash and cash equivalent. Now, what does that mean? Cash equivalent. Cash
Something like-
equivalent.
Something like almost as liquid as cash. Like,
Any financial instrument that you can collect within 90 days
or less.
or less, that's considered cash equivalent. Yeah. Cash equivalent may include money market accounts. Do you have any? You know what's money market accounts? It's a type of saving account, but it has usually a little bit more interest on it than a regular saving account. Commercial paper. What is a commercial paper?
Short-term corporate.
Short-term corporate notes, but that means sometimes corporations would borrow money from the bank, and based on faith. That means the company has a good reputation with the bank, and the bank would lend the money to it's unsecured. You could say it's an unsecured note.
Well, basically, the only way a bank could give a big loan to like a corporation if they done business before with the
Yeah,
bank. They don't
that's what
have
I'm saying.
time.
They have faith in the business. Yeah, they have faith in the business. And you can see Let me go to chapter 15, page. Go to the statement of cash flows, comprehensive. What's this? Oops, I'm chapter 16. Go to page. It doesn't show, does it? On page 602, I think you may say something on page 602. Suppose, for example, a company has 1 million that it will not need for 30 days. To earn a return on this amount, the company could place the cash in an account that earns interest, such as money market account. Not that. It's not the one I want.
I mean, he's giving an example. Well, not really giving an example.
It's not a commercial paper. No. That's
It said can lend cash to another corporation by purchasing the corporation's short-term notes. They call it commercial paper.
Say it again.
It says it can lend cash to another corporation by purchasing that corporation's short-term notes, which is, they say in parentheses, called a commercial paper.
Okay. For example, that's the example itself.
That's on 602.
A company invests in cash equivalent to earn interest on cash that would otherwise be temporarily idle. Suppose, for example, that a company has 1 million that it will not need for 30 days. To earn a return on this amount, the company could place the cash in an account that earns interest, such as money market account. Lend the cash to another corporation by purchasing that corporation short-term notes. Okay, see, that's a different. Lend the cash to another corporation by purchasing that corporation short-term notes. So that means if the let's say you have two, you have a notes payable to the bank. If he buys it from you, he buys that because he may offer you a little bit less than what. Yeah, because he needs to get his fee for that. Why is he? He's assuming your debt. Yeah. Okay, he's assuming your debt. So. Okay. Anyway. And then you have treasury bill. This is a government you could say security. That's a treasury bill. The government sell you that bond at a discount price. Let's say if it is $10,000, they will give it to you for $9,000, and then when you go and collect the whole $10,000 after a period of time, no specific interest is stated on that. So these are cash equivalents: money market account, commercial paper, and U.S. Treasury bills. Okay. Okay, cash equivalents should not be confused with short-term investment. They are also called marketable securities. So marketable security also is a short-term investment, but it's less liquid. Okay, it's not, because you may hold a marketable security for more than a year, more than 2 years maybe, and then you sell it when the time is appropriate. Yeah. Purchases of marketable securities are treated as cash outflows, and sales of marketable securities are treated as cash out inflows. Okay, because when you sell, now you have cash inflows. When you buy, you have cash outflows. Yeah. Transfer between the cash account and cash equivalent are not treated as cash inflows or outflows. Why? Between cash account and cash equivalent. Because it's your cash. There's nothing in coming in. You're moving it from your cash equivalent into your cash. It's not something new coming in. All right? It's not something new coming in, yeah. Unless it's the new addition, then you can say, yeah. All right? So the statement of cash flows provides information about a company's cash receipts and cash payments during a period. Cash receipts are your inflows and cash payments are your outflows. Yeah. I think you can read this statement on your own, this thing. All right. Operating activities, these are your normal business operations. Yeah. Now, which statement does reflect your operating activities?
Income statement.
Yes, the income statement. Yeah. Operating activity and involves two cash inflows and outflows from activities. One is from your income statement, and the other area is changes in your current assets and current liabilities. So you got to look at both the income statement and balance sheet. The balance sheet specifically current assets and current liabilities. Okay. So cash inflows include cash receipts from the sales of goods and services. That's your normal business operation. And then cash receipts from sale of trading securities. Trading securities are your shares of stocks or shares of bond or bond certificates, all those. Yeah. These are marketable securities that a company buys and sells for making profit. So when you buy a bond certificate, you hold it for a year only, or you buy shares of stocks, and the purpose is marketing, buying and selling, in order to make profits. Yeah. Okay. Cash outflows include cash payments for wages, inventory, expenses, interest, taxes, and also purchases of those securities. When we say securities, those certificates of bonds and stocks. Yeah. Okay. Or treasury bills. Yeah. Now, investing activities, they have to do with your long-term assets. Okay, immediately. Think of it that way. Your purchase and sale of long-term assets. Your operating activity have to do with your income statement. That means you're obtaining revenues and incurring expenses, all of that, and you're going to look at your changes in current assets and current liabilities. Investing activities, they have to do with your long-term assets. Okay, buying and selling long-term assets. So involve acquisition and sale of property, plant, and equipment, and other long-term assets, including long-term investments also. What's the difference between long-term investments and short-term investments?
Long-term investments, like it'll take like over a year, or the operating cycle. Short-term investments that you get within less.
Give me example.
Short-term investment, like say you invest.
You're buying shares of stocks,
and you want to receive like.
and you hold it for less than a year. Yeah.
Yeah.
But in the long-term investment, the same thing, you may hold the shares for over a year, or you may buy a piece of land. That's not your normal business operation. You hold that piece of land for the future use or purposes. Yeah. Mm-hmm.
Or just start building on it.
Cash inflows include things like selling marketable securities other than trading securities, selling long-term assets, collecting on loans. Cash outflows include cash expended on purchasing securities and assets, cash lent to borrowers, long term, okay, purposes. Yeah. Now, financing activities have to do with your long-term liabilities. Okay, just like if you want to remember the meaning of these things, here's how I remember. There are three sections of cash flows: operating activities, investing activities, and financing. Remember those three sections. Operating is your income statement and changes in current assets and current liabilities. Investing is it had to do with long-term assets, buying and selling long-term assets. Financing activity has to do with your long-term liabilities. Long-term liabilities. So if you an equity, say long-term liability, that's the only thing we didn't mention in the financial statements. We mentioned current assets, current liabilities. We mentioned long-term assets. The only thing is left long-term liabilities and owner's equity or stockholders' equity. Yeah, so those are financing activities. Long-term liabilities and owner's equity or stockholders' equity, those are financing activities. Okay? So cash inflows include proceeds from stock issues, which includes cash. When you issue stock, that's a financing activity. Short-term and long-term borrowing. When you borrow money, that is a financing activity. Why do you raise funds? Why do you borrow money? You're trying to finance something. Yeah. All right. Outflows, payments of loans, excluding interest. Why?
Because it may be
The interest is a special case. If you are receiving the interest, it's an operating activity. The same with dividends. If you are receiving dividends and interest, is considered operating activity. If you are paying the dividends to the shareholders or paying interest to the bondholders, that's financing activity. Okay, so the interest and the dividend is a special case. Okay, so if you are receiving it, it's an operating activity. If you are paying it, it's an it's a financing activity. All right. So cash outflows include payments of loans, payments to owners, including cash dividends. See payments. Okay. Payments of loans. Yeah. Well, excluding interest, because it depends on whether you are receiving it or if you are paying it, it's financing activity. Okay. Treasury transactions are also considered financing activities. Repayment of accounts payable or accrued liability are not considered repayment of loans and are classified as cash outflow under why it is an operating, not financing. Accrued accounts payable, these are current liabilities. Yeah. All right, these are current liabilities. Companies occasionally engage in significant non-cash investing and financing transactions. Those are making lots of noise. Huh?
We got to deal with that next period.
Huh?
Got to deal with that next class period.
You can read these on your own. I want to go to, there are two methods of preparing the statement of cash flows. There is the direct method and the indirect method. Okay, and if in terms of use, which one is most widely used? Which one is the indirect method? The most widely used is the indirect. You would say 95% of corporations use the indirect method, and very few use the direct method. Yeah. Very few. The difference in the two methods is in the operating section. Okay, the difference in the two is in the operating section. But the investing and financing section is the same for both methods, the direct and the indirect. The two only different in operating section. Okay. The indirect method does not require the conversion of each item in the income statement. It lists only the well, in fact, indirect method, that's what it involves, really. You got to change, like this net income that those sheets I gave you. Look at the income statement for a second. Yeah, the income statement. At the bottom of the page. Yeah. You see this net income?
Yes, sir.
This income is done on accrual basis. On accrual basis. We have to change it into cash basis. Yeah, that's what the indirect method. You change, so you start with your net income with this one, and then you go back over here, see some items that you have to take out from it. And some items you need to add to it. From here, you recalculate the 16,000. You recalculate it. You redo it. So you start with it, and you're going to look at this item by item, and you look at some items you have to add. You originally deducted, but you have to add it back. And you originally deducted, you have to add it back. So if you added something originally, you deduct it. If you deducted something originally, you add it back. You see what I'm saying? And the things like you originally deducted, like depreciation, amortization, or depletion, those are usually deducted and losses. But when you change, redo the 16,000, you have to add those back. So if you have depreciation or amortization or depletion, you add it back. Okay, you add it back. If you have a loss, you add it back too. Okay? If you have a gain, you subtract it. Why do we add the loss back and we subtract the gains? Because these are not operating activities. Not operating activities yet. Okay? So that's why you do this. So, in preparing the statement of cash flows, it involves 4 steps. Determine cash flow from operating activities, which is the readjusting the income statement. That's the first step, using the indirect method. Okay, but if you use the direct method, cash flow from operating has in it formulas. So we're not going to use it yet.
So it's using direct method takes a lot more work than using the indirect method. That's why.
Yeah, and you come up with the same results.
Oh.
So you look at your cash receipts from operations and cash payments, and you see the difference between the two. There are formulas. You got to look at your account receivable, beginning balance and ending balance, and stuff like that. Yeah, and your cash payments. You look at your also your expenses, accounts payable, beginning balance and ending balance, all of that stuff. So it's easier when you come up with the same results. That's why majority of the businesses use the indirect method. Yeah. Okay. So we determine cash flow from operating activities. We determine cash flow from investing activities. Now we look at investing. We look at that's why the second sheet. Look at the second sheet. That's why you have 2013, 2014. So you look at the long-term assets, changes in long-term assets, and then also you may have some additional information. You might say, oh, we purchased a building, or we sold the building at a loss, like that. Okay, or you can say, you can look at the long-term assets, your current, like investment, planned assets. Look at the changes. If it's changed, if it's positive change, I mean you purchased some of that, and that means it's cash inflow. If it went less, it might have been sold, and so that means you have inflow. Yeah. Okay. So, and then you look at cash flow from financing activity. We're going to do those in details, guys. Okay. We just give you the layout. Yeah.
Introduce me.
Yeah. Financing, you look at your long-term liabilities and your stockholders' equity. And you're going to look at the changes. Okay, that's why I gave you, the book has 2 years. That's called comparative balance sheet. You have figures at the beginning of the year, 2013, and figures at the end of the year. So every year, its beginning balance is the previous year, and its ending balance is the current year. Every year, then the 14 will be the beginning balance of the 15. The 15 will be the beginning balance of the 16, and on. Yeah. Okay. And also you have prepared statement of cash. You have one more item, non-cash activities. I don't see it in here yet. Non-cash activities. That means if you remember the example that we had, the lawyer fees, or you exchange a building with stocks, or you exchange equipment with stocks, and like that. You got to include it in the statement of cash flows on a separate section in the bottom. Yeah. And once you find out the balance, so each of these has inflows and outflows, inflows and outflows, inflows and outflows. And then you see the balance, whether you have more inflows or more outflows. You add the three balances of each. So you look at the balance plus this balance plus this balance. And the key to see if your work is correct or not is the difference between the cash. So here you have a positive of 32,000. So once you add the balance of your operating activities, the balance of your investing activities, and the balance of your financing activity, if you come up to positive 32, your work is correct. If it doesn't come to 32, that means you did something wrong, and you go back and start all over again, or see where you went wrong.
Oh, okay.
Yeah, and maybe you discover your mistake, and then you say, oh, here where I went wrong. Yeah. So have you noticed in the current assets we don't use the cash when we look at current assets? We look at cash. Cash is the one we try to explain. Okay, cash is what we are trying to explain. Okay, this is just a repetition of what I was saying. Yeah, the indirect method focuses on adjusting items on the income statement to reconcile net income to net cash flow from operating activities. These items include, see, you look at depreciation, amortization, and depletion. If you have them, you add them to the net because we originally deducted them. So you have to add them back. If you have gains and losses, you subtract the gains and add the losses. And then you look at changes in current assets and liability. We have rules of those, and we're going to next time on Tuesday, by the grace of God, we will continue from here. Okay, we'll continue from here, and because we need our minds to be clear when we do the figuring. Okay. Yeah. All right. Let me stop broadcasting.
too.